Hey, I'm Danielle Shaw with ABCT Traders and Analysts, and welcome to today's trading lesson. Every indicator is just old price. Learn to read the source. We're breaking down price action and candlestick patterns from the ground up, what it actually is, how it works, the exact rules for getting in and getting out, a real worked example, the mistakes that trip most beginners up, and how we put it to work in our own trading. This is education only. So stick with me to the end. And if you want real-time trade alerts, our free Telegram link is in the description. Let's dive into the world of price action. So what exactly is price action? Well, it's all about trading directly from the chart. We're focusing on candlesticks, swings, and key levels, rather than relying on indicators that often lag behind. Think of indicators as formulas built on top of price data, which means they're always just a step behind the actual market movement. Price action traders, however, skip that middleman and look straight at the price's footprints. At the heart of this approach is the candlestick itself. The body of the candle, which represents the open and close, shows us who won during that period, while the wicks indicate price rejections. It's like reading the market story without any distractions. By learning to interpret these candlestick movements, traders can make more informed decisions based on real-time data. Now, let's explore how price action works. There are a few high-value candlestick patterns that really do most of the heavy lifting. For instance, the hammer pattern has a long lower wick and a small body at the top. This indicates that sellers pushed the price down, but buyers quickly drove it back up, suggesting bullishness at support. On the flip side, we have the shooting star, which has a long upper wick, showing rejection of higher prices. This is typically bearish at resistance. Then we have the bullish and bearish engulfing patterns. These occur when a candle's body completely engulfs the previous candle's body, signaling a decisive shift in control. Beyond individual candles, we also look at market structure. For example, higher highs and higher lows indicate an uptrend, while lower highs and lower lows signal a downtrend. A break in that structure could indicate a potential reversal. When it comes to price action, context is everything, and that means there are no specific parameters. What really matters is where the pattern appears. For instance, a hammer at support carries much more weight than one that's floating in midair. The time frame also plays a crucial role. A pattern on the 15-minute chart typically has more significance than one on the 1-minute chart. Additionally, we look for confluence, which is when a pattern aligns with a key level, a moving average, or the volume-weighted average price, VWAP. Understanding these contexts ensures we're making more informed trades based on where and when we see these patterns occurring. Let's talk about entry rules. First and foremost, mark your key levels like support, resistance, and prior highs and lows. Once you've identified those levels, wait for the price to reach one of them. The best time to enter is on the close of a confirming reversal candle, like a hammer at support or an engulfing candle breaking through resistance. Avoid entering based on a wick midbar, as it can be misleading. When you're in an uptrend, structure your trades by buying the higher low after a pullback. This strategy helps you align your trades with the overall market movement, increasing your chances of success. Now, let's discuss exit rules. When it comes to targeting your exits, aim for the next structure level, prior swing high, resistance, or even a round number. As for your stop loss, place it just beyond the wick of your signal candle. For example, that means below the low of a hammer, or above the high of a shooting star. If the low of that candle breaks, it indicates that your initial read was incorrect, and it's time to reconsider your position. Having clear exit rules helps you manage your risk and maintain discipline in your trading practice. Let's walk through a worked example to solidify our understanding. Imagine a stock that's in a clear uptrend and it pulls back to a rising support line. It prints a hammer with a long lower wick that touches support and then closes near its high. In this scenario, you'd enter your trade at the close of the hammer, setting your stop just one tick below its low. Your target would be the prior swing high. This setup offers a tiny risk, just the wick of the hammer, while the potential reward is the entire previous leg of movement. This creates a textbook 2-to-1 or better setup, all achieved without any indicators. Now, let's weigh the pros and cons of using price action. The advantages? It works across any market and time frame. There's no lag because you're interpreting live price movements. Plus, it forces you to truly understand why prices move, giving you the ability to set logical, tight stops. On the flip side, there are some drawbacks. Price action can be subjective. Two traders might interpret the same levels differently. Furthermore, patterns can fail in choppy, low-volume environments, and it often requires screen time to develop that instinct for recognizing patterns quickly and accurately. Balancing these pros and cons is essential to your trading journey. Next, let's discuss common mistakes that beginners often make when using price action. One common error is trading patterns that form in the middle of nowhere instead of at key levels. It's vital to wait for the right context. Another mistake is entering mid-candle instead of waiting for the close, as wicks can easily retrace. Many beginners also try to memorize 50 exotic patterns instead of mastering just 4 reliable ones. Lastly, ignoring the higher timeframe trend and attempting to fade it can lead to poor results. Focusing on these common pitfalls can help you streamline your learning process and improve your trading outcomes. Finally, let's see how TradeAlgo applies price action in its strategies. The scalper strategy is a prime example. It builds a 15-minute opening box and then waits for key patterns like a hammer, shooting star, or bullish-bearish engulfing candle to reverse back through that box. Additionally, the My Rules Smart Signal incorporates candle patterns as one of its 4 confirmations. Each pattern is strictly defined in a system based on wick and body geometry, ensuring precision in trading decisions. This blend of automation and price action principles can enhance your trading experience. To wrap things up, here are some key takeaways about price action trading. Remember, indicators tend to lag behind. Price is where the action is, so learn to read it directly. A candle pattern only holds significance at a level, so always consider context. Focus on mastering just 4 essential patterns, like the hammer, shooting star, and the 2 engulfing patterns, rather than trying to memorize 50 different ones. By honing these skills, you'll be well on your way to becoming a more effective trader. And that's price action and candlestick patterns start to finish. If this made the strategy click for you, do me a quick favor. Smash that like button and subscribe, because we drop a brand new trading lesson every single Sunday. Drop a comment with the strategy you want next, and join our free Telegram channel for real-time alerts with exact entry and exit levels. The link is in the description. Remember, this is for education only, not financial advice. Every strategy has losing trades, so always manage your risk and trade safe. See you in the next lesson. And if this video helped you in any way, please hit the like button and subscribe to the channel. It really motivates us to keep making these for you. And join my free Telegram channel for daily alerts with exact entry and exit prices. The link is in the description.